Good afternoon and welcome back to the Week in Markets, a review by your investment professionals on what's happened in global markets this week. I'm Kevin Kidney, Investment Director here at True Potential Investments, and I'm joined by George Bell, an investment manager on our team here. Afternoon, George.
Afternoon.
So what we're going to cover today is mainly equity markets. It's been quite a light week for economic data. However, there's lots of exciting things going on in equity markets. George, you know, it's probably worth starting in Nvidia. We don't often like to talk about individual stocks because that's not what we're about, but Nvidia is probably capturing the major theme in equity markets here. So could you give some colour on their earnings and how we think it's driving equity performance elsewhere?
Yeah, absolutely. So we've got Nvidia, US technology business, which essentially has been reporting some very stellar expectations around their future earnings. We look at the fourth quarter delivery, they saw their earnings increase 265%.
Yeah.
That takes the total fourth quarter revenues to $22.1 billion US dollars, which is a phenomenal number. And essentially the theme underpinning a lot of that drive is the development of artificial intelligence, computing power and requirements around this, which is lifting not only Nvidia, but it's driving a lot of charge across markets, particularly within the tech space.
And it's not just AI chips, is it? For instance, their cloud-based services doing very well, very cash generative. It's feeding into other markets. As you said, Switzerland's number one stock is producing semiconductors. This all fits into producing chips for AI. So that clearly is the next big productivity boom for industry, for businesses, for commerce. Now it's been very narrow, isn't it? Because Nvidia is surging ahead, but it's been very good for market cap indices, particularly in the US.
Yeah, certainly. I mean, if we look at the US market so far this year, positive. A lot of the drive has been through the technology and in that sector. However, what we are seeing is there are other places in which you're generating a positive return within the US market. Japan's a great example. A few things which are going on in Japan. You've got, it's been a cheap market for a while. It trades at around 2/3 of the value of the US market. But what you're seeing there is a real push in terms of the earnings growth.
Yeah.
So earnings in Japan are expected to grow by about 10% this year, which is around very close to what you're seeing in the US, which is, you know, the highest expected earnings to market in the developed market space, and actually starting to see that being revised up. And it's a lot of the companies which are linked into the semiconductor industry which are driving that.
And it's important to add, isn't it, that it's the only major region in the world that's seeing positive earnings revisions, where not just for this year and next, earnings growth is being increased. Whereas even in the US, we're still seeing outside of the tech names, earnings expectations are being revised down.
Yeah, absolutely. And, you know, couple that with a number of other sort of structural dynamics in Japan, such as the reforms made by exchanges to encourage businesses to return some of the large cash piles back to investors through way of dividends or share buybacks. Corporate regulation in terms of governance, a weaker currency, and also just some domestic changes which they're making to encourage investment by domestic investors.
Absolutely, yeah, and it's a true structural story of constructive return on equity for investors. We're also seeing performance in Europe, again, for many of the same reasons we've discussed here: tech, biotech, leading. Although it's a small number of names, it benefits the indices, so you know it's good to be fully invested, but also it's good to see that the performance of a few names feeds into broader index performance. We're jumping ahead a bit, but one place it hasn't performed for is the UK. A comment on the UK and why we think it's lagging?
Well, we've seen, once the industry makeup, it's got less exposure to the technology and biospace area. Also just, you know, economic growth is weaker in the UK than what we're seeing and also expecting in areas like the US. We had some interesting developments this week in regards to central bank comments, which were essentially just trying to push back on expectations of interest rates coming down by, you know, spring. It's much more certain that it'll be something which we'll see in the summer.
That's a great point, a good segue into, you know, how remarkable equity performance has been, is that it hasn't been reliant on interest rate expectations being pushed for more cuts, interest rates being pushed lower. In fact, interest rates, market-based interest rates, have risen. What would we characterise the market as looking at that's caused expectations for this year for the US and for the UK to price out some of the rate cuts that we began the year with?
One of the aspects in the US is the inflation dynamics that we're seeing. A bit of a slowdown in the momentum which we were seeing in the final quarter of last year. Essentially, markets were required to take their expectations closer to those which were set out by central banks. In the UK, you're looking, rather than sort of more firmly 4 to 5 cuts, it's more like 3 to 4 now is the general expectation. But as you say there, Kevin, the market response after we heard that those comments from Andrew Bailey in the Bank of England weren't dramatic in the UK. So markets are pricing in a lot of that expectation.
It is noticeable, isn't it, actually, that if we were to compare the UK and the US economies, seem to be very different trajectories. The UK does seem to have a much weaker growth impulse, a genuine disinflation impulse to accelerate into the middle of the year, and yet interest rate cuts have been priced out here, despite Governor Bailey leaning into the likelihood of them cutting before inflation reaches 2%. So it's as if interest rate expectations in the UK are perhaps being driven more by global events, growth surprises, not just in the US, but perhaps in Europe, and also the good news story that we've seen from Japan.
Yeah, and wage growth pressures were quite pertinent in terms of the comments from Andrew Bailey in there as well, which if we look at how we would expect wage growth pressures to evolve through the course of this year, we would expect the impact to moderate in the inflation reading.
Yeah, and again, that's the unusual nature of the way the wage data in the UK has been pushed higher. Was these one-off pay awards in the public sector in particular as a result of strikes. It's made the data very lumpy, but that will, as you say, subside. Now, we're at the end of the week, so we can look back on some of the activity data that did come out. We saw some good news from Europe. Now, we have to be somewhat circumspect on our optimism here. Leading indicators in Europe have pointed to the services sector in particular being in a recession. The PMIs yesterday, they surprised to the upside. So it's a modest surprise, isn't it? And it's perhaps something that we should expect to continue. Yeah,
but it's important in areas like France, where services make up about 80% of the economy. You are seeing that demand for labour remain, because they're optimistic about what they see in terms of future orders. Orders have been slowing, but generally the expectation is for them to see a bit of an improvement come through. And there were some signs of that in terms of the manufacturing sector, but to a lesser degree. So services are still doing a lot of the legwork in Europe there.
So that's great. So thanks, George. So just in summary, we've seen great equity performance this week, but it's a theme of broadening equity performance, not just the US, it's Europe and Japan performing very well at all-time highs. It's been driven by strong economic growth, albeit from low expectations, and that's helping to push back on some of the interest rate cut expectations we've had that we began the year with. So thank you everyone for joining us. As a regular reminder, please do like and subscribe to our YouTube channel or to our podcasts, if that's how you prefer to get your media. And please do join us next week for our week ahead on Monday. Thank you.